Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I've got a really special piece for you, something that I have drawn on for inspiration when the stock market has sold off. Many times I've used this. And this is a piece by Warren Buffett that he produced for the New York Times years ago in the depths of the financial crisis. I first came across it in March 2020 when the stock market was selling off so much due to the uncertainty of the COVID pandemic. And I got onto Google, did a quick search, and I came across this article, and it actually inspired me to start entering the market in the depths of the COVID sell-off. So much so that I actually went to 100% into stock ETFs in my portfolio at that time. Something I never would have done if I did not get the inspiration from Warren Buffett in this fantastic piece he wrote for the New York Times. So I want to share that with you. We're going to break it down pretty much line by line because it's really a gold mine of information. And at the moment, I think it's very relevant given the kind of tariff turmoil that we've seen and a lot of people feeling so much uncertainty. And of course, loads of headlines about US exceptionalism, US stock market economy coming to an end, and people really wondering what they should be doing. So let's get into this line by line, Warren Buffett's piece in the New York Times in October 2008. All right, so here on my screen is a copy of this New York Times op-ed that Warren Buffett did in October 16th, 2008 in the depths of the global financial crisis. Remember, this was a time where the markets were far scarier than they are right now. There was even thought that the whole global banking system could collapse. So let's have a look at this piece here. The title of the article, of course, is Buy American, I Am by Warren E. Buffett in Omaha. I've made some highlights, but I do think it's worth going through this line by line anyways. Let's go through it. So the financial world is a mess, both in the United States and abroad. Its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. We're seeing that now. Whenever the markets are selling off and there's some sort of economic shock or crisis, the headlines in the media go crazy negative. It's just common and something I've seen over my last 20 years in the business. As he goes on to say, so I've been buying American stocks. This is my personal account I'm talking about, in which I previously owned nothing but United States government bonds. This description leaves aside my Berkshire Hathaway holdings, which are all committed to philanthropy. If prices keep looking attractive, my non-Berkshire net worth will soon be 100% in United States equities. Think about that at the time where the markets were selling off an awful lot. But remember, the market didn't bottom to March 2009, and he's already going almost all in October 2008. Why? Well, a simple rule dictates my buying. Be fearful when others are greedy and greedy when others are fearful. This is one of the best pieces of advice that Warren Buffett has ever given. And I think it's a mantra that we should all be living by when you're investing in the stock market, which we're all doing, whether that's through a 401k, self-invested personal pension, workplace pension, wherever you are in the world, you probably have some exposure into the stock market, whether you know it or not. And this is such an important rule. I'm actually going to call that lesson number 1 from this piece on Warren Buffett. This is absolute gold. So lesson 1, be fearful when others are greedy and greedy when others are fearful. Let's continue on. And most certainly fear is now widespread, gripping even seasoned investors. To be sure, investors are right to be wary of highly leveraged companies or businesses in weak competitive positions. But fears regarding the long-term prosperity of the nation's many sound companies makes no sense. These businesses will indeed suffer earnings hiccups as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. Long-term mindset, super important when you're investing in the stock market, despite the headlines as they are. But he goes on to say, let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. Let's call that lesson number 2 from Warren Buffett of this article. Warren Buffett, who's been at this for something like 60 years, has no idea where the stock market is going in a year or so. And guess what? If he doesn't, neither do you, neither do I, and neither really does anybody else that you see talking on the news media. So bear that in mind. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. This, for me, is an absolute key point on this. I'm going to mark this as number 3 lesson that we take from this. The market will move higher before sentiment changes. I certainly saw this in the dot-com bust and the global financial crisis, absolutely. I remember standing around having conversations in 2011, 2012 with people, clients, friends, other investors, who all believed that we were still not out of the depths of the global financial crisis and the market had still not fully bottomed. It was known as the most unloved bull market for most of the 2010s. That is absolutely incredible. And look what it did from March 2009 right up to 2020 when the COVID crisis hit. So remember, it almost always, when we talk about the stock market, comes back before the actual economy does and way before people expect it to. So bear that in mind. And it's very hard to catch that big move up before it happens. Okay, so continuing on with the article, we'll just bypass this image. Okay. A little history here, he goes on to say. During the Depression, the Dow hit a low 41 on July 8, 1932. Economic conditions, though, kept deteriorating until Franklin D. Roosevelt took office in March 33. By that time, the market had already advanced 30%. Or think back to the early days of World War II when things were going badly for the United States and Europe and in the Pacific. The market hit bottom in April 42, well before Allied fortunes turned. Again in the early 1980s, the time to buy stocks was when inflation raged and the economy was in the tank. In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. And we're getting bad news now, lots of bad news. So this is a fantastic lesson again, number 4, let's call it, from Warren Buffett on this. Bad news is an investor's best friend. Okay, continuing on, over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions, and the financial panics, oil shocks, a flu pandemic, we can now add in COVID as well, global pandemic that is, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. That's in a 100-year period. Of course, it's long term, but look at those figures from 66 to 11,497. Incredible stuff. And here we get into another really good point here. You might think it would have been impossible for an investor to lose money during a century marked by such extraordinary gain. But some investors did. The hapless ones who bought stocks only when they felt comfort in doing so and then proceeded to sell when the headlines made them queasy. Sadly, this is something I see all too often in my day job and just conversations I have. People go with their instinct. Buy stocks when the market is going up and the headlines are good, and sell them the moment stocks are going down and the headlines are bad. You will have terrible results in your investments for sure, and it's not the way to go. You've got to overcome that intuition and that feeling, that instinct of doing that, buying when you're comfortable and selling as well when the markets go down, because your results will be terrible. Okay, now we get into another great lesson, the 5th and I think final lesson on this, which I think is one of the most important ones. He goes on to say, today, people who hold cash equivalents feel comfortable. Sound familiar? A lot of people are making comments that they're holding cash right now. They've gone to cash. They want to wait this out. They should not. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Lesson number 5 from this amazing article from Warren Buffett. He goes on to say, indeed, the policies that government will follow in an efforts to alleviate the current crisis will probably prove inflationary and therefore accelerate declines in the real value of cash accounts. Now, we didn't really have much inflation immediately after the global financial crisis. But nevertheless, we did have inflation through 2022. And if you had kept in cash or mostly in cash, 2010, 2011, 2012 and onwards, of course, you drastically underperformed the stock market, and therefore the wealth that you would have accumulated in your portfolios would have been substantially less just for being in cash. So cash is therefore a terrible long-term asset. Equities will almost certainly outperform cash over the next decade. Notice how he's thinking in decades, not in the next year or two, probably by a substantial degree. Those investors who cling now to cash are betting they can efficiently time their way or their move away from it later. In waiting for the comfort of the good news, they are ignoring Wayne Gretzky's advice. For those of you who don't know, Wayne Gretzky was the best ice hockey player who's ever lived. And his quote was, "I skate to where the puck is going to be, not to where it has been." He's thinking ahead. Okay, and this is how Warren Buffett employs this and his investments. Great piece there. Okay, let's move on. Okay, and now we'll finish up the article in his last paragraph. I don't like to opine on the stock market, and again I emphasize I have no idea what the market will do in the short term. But nevertheless, I follow the lead of a restaurant that opened in an empty bank building and then advertised, "Put your mouth where your money was." Today, my money and my mouth both say equities. What a fantastic piece by the greatest investor of all time. And it's filled with goldmine of information and lessons. As I've said, I use this piece to inspire me to invest into the stock market at the depths of the COVID crash. And it was one of the best things I've ever done in terms of growing wealth in my portfolio over the long term. No doubt about that. So I hope you really found this useful and as useful as I did. Warren Buffett is an absolute legend at this stuff, and we should take everything he says, and learn from it and try and apply it to ourselves. I hope you liked the video. If you did, why not click on the like button, subscribe to my channel if you haven't done so already, and leave me a comment and tell me what you think about Warren Buffett's piece from October 2008 and whether you found that useful for you in your investment journey. By the way, if you want to know what I hold in my portfolio, I did a video on this recently. I'll put a link to that up here in my one fund portfolio. So just click on that. I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.